Hello, my name is Tom Princeville. You are welcome to FinInvest Niger. I'm a certified securities and investment specialist, and I've been investing for the past 20 years. I want to talk to us about exchange traded funds. And these are funds that are traded in the stock market just like regular stocks. It involves the pooling of funds from investors to invest in asset classes like stocks, bonds, as well as some commodities. So you have different kinds of ETFs. You have stock ETFs, you have bond ETFs, you have sector ETFs, commodity ETFs, international ETFs. In fact, the list is as much as your imagination, your creativity can accommodate. So I want to talk about the pros and the cons of investing in exchange traded funds, the advantages and of course the disadvantages, the merits and the demerits of investing in exchange traded funds. Number one here is diversification. That's under the pros now, diversification. There's this exposure to a basket of securities in one trade. You buy a single ETF, and that ETF has different securities under one umbrella. So you are exposed to different securities, different instruments in a single trade. So a typical ETF is highly diversified, which of course is a very, very important advantage of investing in this vehicle. Number two is low cost. Low cost. Generally, these are lower expense ratio than mutual funds. Expense ratio essentially means the fees that mutual fund managers charge their investors. So those fees are called expense ratio. In the case of exchange traded funds, the expense ratios, is somewhat relatively lower than what a typical fund manager would charge. Number three is liquidity. In the aspect of liquidity, these stocks or these instruments or these funds are traded openly in the stocks exchange. They are done on a daily basis, like the way you trade you buy and sell regular stocks, common stocks in the market. And so the liquidity is there. You can very easily decide to sell your ETFs, or if so wish, you could decide to also buy an ETF in the market the way you buy stocks, the way you buy and sell stocks, because of the level of liquidity inherent in this investment vehicle. Number four is transparency. Transparency here indicates the fact that holdings are disclosed daily. A typical ETF holds a number of instruments, and these securities are there for investors to actually see. There's nothing hidden about it. So you could see precisely what a given ETF is holding at a particular point in time. The constituent securities that makes up the portfolio, are there for investors to peruse on a daily basis. That's why it is known to be transparent. Number five is flexibility. So in this case, it can be bought and sold and then traded like individual stocks in the market. Just like you trade stocks, you buy and sell stocks. That's how you equally buy and sell ETFs, exchange traded funds in the markets. So that's as a result of the flexibility, the flexible nature of this investment vehicle. Number six is tax efficiency. When it comes to tax efficiency, there's this lower capital gain tax due to, a kind of creative redemption. In other words, when you redeem, when you dispose of your ETFs, it is called redemption. So it attracts a lower capital gain tax. there's lower capital gains because of the nature of how these funds are traded. They don't just like they don't just appreciate like common stocks. So in this case, there's a lower level of capital gains, which also result in a lower level of taxable income, on your part as an investor. Number seven is variety. When we talk about variety, you know, you have equity ETF that deals with stocks. You have bond ETFs that essentially have bonds in its portfolio. You also have sector ETFs. In this case, the ETF concern trades or deals with securities in a given sector of the market. And also, we have commodity ETF that deals in commodity. We also have thematic ETFs that deals with a particular theme, particular investment theme in the market. The theme could be value, it could be, uh, growth or whatever themes. So you have ETFs that specializes in different thematic investment segments, so to say. Number eight is accessibility. When it comes to accessibility, this fund is suitable for both beginners and even advanced experienced investors. So both beginners and highly skilled advanced experienced investors could very easily invest in ETFs. They are highly accessible to every individual. Number nine here is a passive option. When it comes to passive options, there is this, it's ideal for tracking, an index, and also is also very good and recommended as a long-term investment vehicle. It has index tracking capability. For instance, now, let's say you invest in an ETF that deals with the insurance sector. So that ETF will essentially track the insurance index. Same thing for an ETF that covers the banking sector. The ETF will equally track the, let's say, the NGX, banking index. So it has index tracking capability. Number 10 is there's no minimum investments. So you can purchase a single unit. So it's very, very cheap to buy. You could purchase a single unit based on the net asset value of the fund at that particular point in time. So it's very, very easy to purchase. There's no minimum investments. With as little as your minimal amount of fund or money, you could very easily purchase an ETF. That's all about the advantages of investing in an ETF, exchange traded funds. We want to talk about the demerits or the disadvantages of investing in exchange traded funds. Just like I told us in my other videos, these strategies have both pros and cons, which is very, very important. I take time to make sure you understand, and you're able to weigh the pros and cons before you make your next step in investing or not to invest in these funds. Number one under the cons is the market risk. So you discover that an ETF essentially attracts what is known as market risk. So there's that particular tendency to fluctuate. It tends to fluctuate. It could be volatile, particularly when the underlying assets, either the stock is holding, the commodity is holding, or the sector the ETF is actually playing in, or the industry it follows. Once the assets under an ETF fluctuates, the overall value of the ETF will equally fluctuate as well. The volatility is always there, which could be translated into what is called market risk. Number two is there's a trading cost. Because you trade ETFs like the way you trade normal stocks in the market, so it attracts brokerage commission. There's that particular bid and ask spread it applies. What's the meaning of bid and ask? Generally in the market, you have the bid column and the ask column. All right, the ask column there is the buyer, and the bid column there is 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 they start particular buying and selling column, so to say. So this buying and selling represents bid and ask. So there's a spread between what the buyer wants to pay and what the seller wants to pay. That particular spread constitutes part of the commission that the brokerages would charge you. So the bigger the bids ask spread, the bigger the commission you're going to pay on that particular trade. I want to believe this explanation is understood. It's going a little bit technical actually, but don't worry, we'll get to understand better as we keep on listening to contents of this nature. Number three is I there's that particular over trading risk. So in this case, there's that intraday trading, which encourage speculation. People can trade stocks, trade ETF intraday. In other words, they can buy in the morning and sell in the afternoon. They can buy in the afternoon and sell some hours later. So it encourages intraday trading, which of course leads to over trading. It shouldn't be encouraged at all. Number four is tracking error. Okay, tracking error simply means the deviation between the value of the ETF, the value of the fund, and the benchmark it is tracking. Generally, it tracks a given benchmark. I told us about benchmark when it comes to index investing. Let's say the ETFs invested in banking stocks. So we realize that it tries to track the performance of the banking index against the performance of the ETF itself. And so in the tracking process, there could be errors along the way, along the entire, within the entire process. This is represented by what is called the tracking error. So the returns you get from the ETF may deviate from what you could get if you buy the overall index that covers the sector or the securities the ETF is covering. That is what is known as tracking error. That's the deviation of the returns from the ETF from what is obtainable in the index itself. Number five is liquidity variation. Liquidity variation. So in this case, there is that particular niche ETF that tends to, in other words, there's no sufficient liquidity because of the niche characteristics of the ETF concern. So it's not broadly traded in the market. If you hold that particular kind of ETF, it's very difficult for you to sell. And if you want to buy, it might be difficult for you to buy because there's no adequate shares, on ground for you to buy. You may not really find buyers if you want to sell. So because of the niche nature of some ETFs, in that case, there is that issue of liquidity variation from one kind of ETF to another. So the liquidity level tends to vary. Number six is complexity. Complexity. This is what is called the leverage and inverse ETFs, which tends to increase risks for beginners. When we talk about leverage ETF, they're highly leveraged. When we talk about inverse ETFs, just like the name implies, if an inverse ETF tracks a particular index, if the index goes up, that ETF will go down. There's that inverse relationship. And so if the index goes down, the ETF is expected to go up based on that inverse relationship between them. So when you buy an inverse ETF, you expect the benchmark indices or the benchmark index to drop. So once it drops, you make money as a result. And if it happens to go up, you lose money in the process. So it's a bit complicated, but I'm just using kind of layman language for us to fully understand what is involved in this particular concept. Number seven is no downside protection. There's no downside protection when it comes to exchange traded funds, because losses mirrors market decline. Once the market declines, it shows that the constituent stocks or equity in a given ETF will equally decline. And so once the constituent elements, the constituent stocks or the constituent equity declines in the given ETF, the ETF value itself will then also decline without any downside protection. So the more the stocks it carries goes down, the more the ETF will equally drop in value. I hope you understand what I'm trying to pass across. So please don't forget to subscribe to this channel, like this video, and help me to share this video to people around you. It will do me a ton of good to be able to reach out to as much as 1 million Nigerians with this message of investing. Number 8 is currency risk. When we talk about currency risks, this is more applicable to international ETFs because they are exposed to exchange rate movements. Let's say you are in Nigeria and you are invested in an ETF in the United States. You discover that your returns is going to really vary based on the interaction between the naira and the dollar. So in the case where the dollar is doing quite well, you discover that your investment will do quite well, and vice versa. So that particular currency risk is always available. It's always an inherent part of international ETF investing. Number 9 is concentration risk. When we talk about concentration here, I earlier told us that we have what is called sector ETFs. This sector ETF invests in different sectors of the market. All right, and so in a case where a particular an ETF invests in a given sector, by so doing it is concentrating its capital on that sector. Let's say an ETF decides to invest, maybe let's say in an insurance sector. It then means that it's concentrating the entire portfolio on the insurance sector. And in a case where the sector underperforms, that means that the ETF itself will equally underperforms. And that concentration, brings about a limitation when it comes to diversification, because you're concentrated in a given industry or in a given sector of the markets. Then number 10 is dividend handling. Dividend may be delayed or reinvested or reinvestment limited. Sometimes you may not get a dividend as you expect you should get. And not only that, you may not be able to reinvest the dividends as expected. There's always limitation when it comes to dividend reinvestments, and also, you may not get regular dividends. Once you're not regularly paid your dividends, you will not be able to invest the dividends in the market if you so wish. These are the cons of investing in a typical ETF. You need to understand as a would-be investor, or even as an experienced investor in the market. So always weigh the pros and cons and decide what you want to invest in and what you wouldn't want to invest in based on your investment objective, your risk appetite, and your time horizon. Not forgetting, your ability to stomach risks also comes to play.